Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today we're going to be doing another sector overview. So I've done some of these in the past, some mini ones. Today's a big one, guys. Okay, so stick around. There's just so much to cover. So we're going to get straight into it, and I hope you guys really get a lot of value out of this because I've put a bit of work in and done quite a bit of reading. I think this could well be the second to third most important sector or trend that we might witness over the next 1 to 2 to maybe even 3 decades. So without further ado, we're going to get into it. If you're not familiar, I am a popular investor on eToro. So if you want to add the fund I manage to a watch list, I'll leave a link in the description. And if you enjoy the videos, please do like and subscribe. So today, cuprum is the Latin word for copper. What we're going to cover is the supply-demand dynamics, the price expectations, and some different ways that I'm looking to play the sector and gain exposure to the commodity itself and get some leverage via some of the producers. So if you remember during the grain or the food agriculture sector view that I did a couple of months ago, I really harped on the idea of second and third order consequences. So in that case, we were talking about energy prices rising. So you have the oil price rising leads to natural gas price rising, and with that being a huge cost input for the likes of urea and ammonia, the fertilizer prices have been going through the roof. So exactly as I predicted, we've seen that play out over the last few months. The idea is to you have a fact and you start to think about the ripple effects, which would be the second and the third orders of consequences. And that's something that very few people are able to do. So we want to really push ourselves. I want to push myself to make this a way of being, a way of thinking. So today we're going to look at the supply. We're going to look at how there's much less production than there used to be and or should be. The old mines, we do not have enough capex over the last 5 years because we've gone through a real trough and a bear market for commodities, particularly copper. And we're going to talk about the risk of political theft. Inflation seems to be the thing that a lot of people out there still aren't thinking about or getting their heads around when it comes to cost push inflation, meaning if your input costs, the raw materials of things are starting to increase, that has to be passed on somewhere, okay? For something like as critical as electrical infrastructure, which requires a heap of copper, that is not insignificant. And obviously we'll talk about monetary inflation and supply scarcity. We'll look on the demand side, electrification, normal repairs and growth, so that will be obviously putting stress on the annual global consumption of copper. And the key question at the end of the day is, depending on the equilibrium between these two variables, what's that going to do to the copper price? I'm going to talk about how I personally think the copper price will be higher for longer due to factors such as a higher all-in sustaining cost and incentive price, which we will look at and provide some hard numbers as always. As you know, I'm from the Jim Rogers school of looking at commodities from the supply side first. Every report I read, for some reason, they all focus on the demand first, which is fine. I just find it a lot easier to look at a supply side first, and you have a lot more surety or reliability if you're looking at an oversupply or an undersupply, and of course that makes it easier to come up with theses around whether you think the price will go up or down. Because demand, I find, is very difficult to measure. Supply, on the other hand, we can get a bit more concrete data. So metals index price has been in decline since 2011 when it peaked. So that was the bear market I was talking about. 2011, we started on a high, then we started to drift down, and we've just seen a relatively recent uptick. Of course, what happens then? Well, it leads to no one reinvesting in new projects for future supply. I mean, if you're selling a commodity and the price is just terrible, below your cost, what it costs you to produce, you're not exactly in a rush to continue to pump it out on the market after a certain point. Yes, I know miners try and make up their margins with volume, but eventually it starts to get old, okay, when you're losing money hand over fist every year. So the spot price is below incentive price. Incentive price is generally the term used, as the name suggests, to incentivize new developments. Okay, so if you own one mine, the incentive price for you to go and open another mine and all the rigmarole and time it takes for you to be able to do that, you need an incentive price to say, well, for me to go through all that effort, I need to be getting a really good price to make it profitable, to make it workable and feasible, to get a decent return for shareholders. Okay, price needed to feasibly start a new production project. Copper reserves have grown at about 3 and a bit compound annual growth rate in line with the capex. So it's basically a 1-for-1. If you see the capex increasing, unsurprisingly, you'll see the supply side reserves increase in lockstep. So nothing rocket science about that. Ernst & Young's sector overview, along with a fantastic piece, the fourth quarter review by Horizon Kinetics. I've taken a hell of a lot from those particular pieces because they really hit the nail on the head, and I think there's a lot of key information. Despite subdued prices, a few major miners made opportunistic investments to increase reserves and acquire operational copper assets to ascertain long-term stability. So it's backing up what we're saying there is no one was really interested in increasing the production or supply of copper, and it's likely to remain in deficit until 2025. Okay, so that's key. We've got a starting point in terms of our supply. We think there's going to be less supply than demand coming into the future. Here's a chart showing the point about the metals index. Okay, so you can see 2011 here it peaked, and then commodities had a hard time of it after that. There was too much supply, too much production, reckless debt financing, and then we started to even out, and it looks as though we're coming back up to the peak here. And so it'll be very interesting to see how that plays out over the next decade. Sticking with production, so here's the amount of production in the blue bars, and I've gone in and calculated the rate of growth and just drawn it in on the top here. So if you look at 2005 to 2015, you're looking at a growth rate of about 2.45% annually in terms of production. So new copper coming on to the global market, whatever that amount is, think about that's grown at 2.45% per year. But we take a look since 2015, it hasn't even been 1%, hasn't been growing at 1%, okay, 0.9% compounded annual growth rate, okay. So we've really hit a lag, and the interesting thing is that you can't just switch on a copper mine and flood the market with production at the moment, because we really just... The deficit is set to continue out into at least 2025, according to Ernst & Young. A lot of other analysts out there and the old timers, the wise old guys that have been in the commodities game for a while, they think it's going to be even longer because of the amount of time it will take to get approvals and to get feasibility studies and all that in terms of starting new projects. Okay, here is a little excerpt from Freeport McMoran, one of the biggest copper producers in the world, just illustrating this point quite nicely. So it's from their annual reviews. Let's look at the capital expenditures. So if we go back to 2013, 2014, obviously they're spending $3.4 billion a year in digging up new copper, okay, and bringing that onto the market. Fast forward to 2021, which was last year, 1.7 billion only. Okay, so everything that goes into developing copper supply, so keeping their mines running and keeping production online, they're spending half of what they were back in 2015. 2014. If you adjust it for inflation, so think about how much things cost back in 2014 versus today, and your diesel costs, your plastic costs, and everything else that goes into input costs for mine, wages, etc., are obviously gone through the roof. Okay, so very interesting to see that they're spending less and less and less as we're going further into a deficit. So it'll take quite a while, one would think, for the producers to be able to turn that around. Now, having said that, here's I guess the only contrary review that I could find, the review that's contrary to the thesis that supply is going to be in a deficit versus demand. And, I tried to look into this. They didn't give much of a reasoning as to why they thought that. Wood Mackenzie Group tended to think that because copper trading at about $4.50 at the moment was enough of an incentive price for them, producers to just flood the market with copper, and they seem to think that supply would outpace demand. Look, in the interest of being fair and open-minded, I put it in here, but I can't say I really lean towards it personally. I tend to think that it's going to be difficult for them, for the producers to start pumping and pushing copper onto the market. And with the demand increases that we're set to see in the demand side of the video, I don't think it will make a dent in the equilibrium as it's gone so far to the one side. So this is the wild card. There are always a few wild cards in the deck, and so when you think about where most of the world's copper comes from, what are some out of the box things that may impact that one way or the other? And one big one is simply the political theft. So if you look at Chile and Peru, they produce roughly 40% of the entire world's supply, and so if something were to happen in one or both of those countries, it doesn't take a genius to figure out that would severely impact the supply. And then if we're starting from a deficit versus demand, then that's just going to increase the supply gap. And obviously the only relief from that will be copper prices continuing to rise even higher. So here's an excerpt from the Ernst & Young piece. The proposed royalty bill in Chile could impact the long-term investment plans in copper. The bill proposes to impose a base rate royalty of 3% on copper sales, which could go as high as, get this, 75% as prices rise. So in other words, the government is going to absolutely fleece the golden goose that happens to be in their backyard. And if they want to be able to extract and produce and sell the copper mined in Chile, the government thinks it's entitled to steal anywhere from 3 to 75% of their sales. Okay, that's not their margins; that's their revenues and top line. So, I mean, this type of thing is going on down in South America at the moment, and so the pendulum seems to have swung that way, especially since the election of Pedro Castillo in Peru. Then this is all just bullish for copper prices. Terrible for the citizens of those countries, but for copper prices, as far as we're concerned, that's going to set an absolute floor underneath the price, because it's basically guaranteeing a supply gap. Do you want to go in and take all the risk of starting up a mine to potentially have it either all your proceeds stolen from you or be extorted at 75% of your revenue? I don't think so. It's not exactly a great deal, and so I think you'll see the major companies tend to either strike a better deal or stay out of the nations and wait until an election or government policy changes. I think that would be the more prudent thing for them to do, and so I think you'll see that's what happens. So when we're talking about supply, incentive price and cost of production is very important, because that will dictate whether you get these new starts and new commodities volumes coming on the market. So all-in sustaining cost and break-even cost, it's a rough proxy for break-even. Okay, it's not perfect, it tends to be understated, but you'll find them in the reports and it gives you a starting point. So $1.90 US, I'll put a question mark there. The reason is I've found most of the majors will quote anywhere from $1.50 to $1.60 as their all-in sustaining cost. Tends to be a bit understated. Some of the bigger ones are even up at $1.90. So I'd be fairly comfortable leaning towards anywhere from $1.50 to $1.90 as a starting point. And that's growing at, or expected to grow at, 2%. It's been growing at 2% year on year since 2018. And with inflation finishing up in the US at 7%, I think that it's likely to grow. The costs of that will grow, if not in lockstep with inflation, certainly as a close step function. What is the incentive cost for new projects? So depending on who you look at, so Woodmac in the review that I read suggests around $3.50 for most producers. $3.20 per pound is the average, according to Ernst & Young's 21 review. So again, you could use either of those or an average of the two, and you'll have a rough idea as to how attractive it is for a copper major to give the green light to some of their new projects and restart. Whereas the all-in sustaining cost will give you a proxy as to how much money they're making. If you look at the spot price versus the sustaining cost, if it's positive, that's a rough proxy for their margins before tax. And obviously if it's negative, then they're losing money for every pound or ton that they sell. Okay, so apologies for the graphic. I had to kind of blow it up, and so it's not really legible. But this was interesting. I wanted to find out who are the lowest cost producers. So who are the guys that if you were to invest in, they've got more margin for safety. So Lundin at the top here, very well run. Everyone interested in natural resources will know the Lundin name. It can get it done at about 64 cents per pound, which is impressive. I don't know how they do it so well, but that's what they've got listed here. Down to $1.57, okay, which Capstone Mining, which their main project is in Mexico. Okay, so anywhere in there, these are the cheapest, most efficient producers as of 2020. Next, we want to look at the copper price over the last, I think I put in 25 years, 20 or 25 years there. I think that's 2000 in the bottom left, so it must be 25. Here you can see from the peak here, 2011, and we had a bear market crawling down, and then we had a bit of a recovery, a little bit of a dip, and now here we are again with prices been absolutely screaming higher. So personally, I would hope for a bit of a correction, but you never know, okay? Here, what I've done is taken the liberty of putting in this thick orange line, which is the $3.50 incentive price. So you can think that the more time that the blue line spends above the yellow or orange line, the more incentive that these producers have to start their new projects, okay? Because when they do their feasibility studies, if they're using $3.50 as their goal, and then they'll compare it to the spot price, they'll be able to see the differences in profit. And once you get your fixed costs, your sustaining costs under control, everything above that is you have massive leverage to the upside as a raw commodity producer. Okay, here is an interesting thing. Let's look at Greenfield Project incentive price. This to me suggests that incentive price is actually a lot higher than $3.50, probably $1 or $1.50 higher than $3.50. If you look at production along the x-axis, okay, and then the dependent variable, okay, the y-axis here as a function of cents per pound, and then you look at the estimates that the analysts have done in terms of what would that be for a producer or developer to engage in a new project and at what price, and here are their expected returns, okay, their internal rate of returns. So me as an investor, if I'm getting less than 20% IRR for something as risky as developing a new commodities mine, I'm not interested. Why would I be interested in that? It doesn't make any sense. There's so much risk attached to it. There's so many things that can go wrong. There are so many hidden costs that will add up eventually. I just don't see anyone green lighting here where you've got this 12% IRR. It doesn't matter if copper was trading at, they just wouldn't green light it. It's not a viable project. If you look at I would say the base case for me personally, 20% IRR, to get that by 2030, you're looking at $4.50 incentive price. Okay, so it's suggesting that if copper prices get to that stage, you'll start to see supply come online, and if they don't, you'll be able to see the gap. Okay, so someone here is suggesting that they'll greenlight a project at 12% IRR. I won't be investing personally because it's too low. In any case, they're saying that about $3, okay, $3 a pound, that they'll be able to bring some supply online. Anything less than that, and you're seeing this huge kind of supply gap in that shaded yellow area, which, I mean, it's almost scary if you think about how high copper has to go and all the hurdles that we've just mentioned over which it must overcome in order to get that new supply on the market and supply the grids that everyone's talking about. And here's in my opinion, the biggest wild card. So what's going to happen in terms of inflation if inflation isn't transitory and it does start to really play out and eat into all the input costs for any commodity producer around the world? What's going to happen to your sustaining cost and what's going to happen to your incentive price then. So let's have a look. Inflation in costs will likely correlate with the spot and the contract price, because if it's costing you more and more every year and you're not getting any more money for the commodity you produce, you're just not going to, you're going to give up, okay? You're certainly not going to engage in new projects. If the current incentive price is 350, we'll take that given the information I just gave you. The question is, what would it be like in 8 years' time, assuming that inflation is at 5% annualized over that term, okay? So if you want to look at a future value, here's the formula. So future value is present value multiplied by 1 plus the interest rate, or in this case we're using an inflation rate, same thing, to the number of time periods, okay? And yes, there are calculators, you can do it online, but where's the fun in that? So we're talking 350 at an inflation rate of 5% annualized, okay, so year on year, and there are 8 years left from 2022 to 2030, okay? So that's suggesting, similar to the chart we saw before, of $5.17 a pound, okay? And so the all-in sustaining cost, if we do the same calculation, instead of being somewhere around 150 to 190, it's looking more like 280, okay? So you can see how you've got this pressure starting to put a floor, higher and higher floor, underneath the expected sustaining and incentive price for copper. That would leave, okay, so if both things just increased in lockstep to the same ratio that we find them today, that would leave the miners with a 45% gross margin, okay? This is their sustaining cost, this is what they're selling it at, roughly 45%, okay? Now let's look at the demand side. So the most critical metal for electrification and energy fuel transition, and it's just going to be everywhere. If you want all these batteries, you want this grid, you need more electricity, you need more copper. It really is as simple as that. It's the only way that you can viably get power from one place to the next and power up a grid. Well, it's not the only way, but it's the only feasible way. You could use silver, but obviously that's a heap more expensive. So it's the second most conductive metal after silver, from what I've been told. Electricity consumption is greater than the population growth, okay? So it's not going to increase in lockstep with population. It's going to increase disproportionately with increases in population, because one person they don't just use set amounts of electricity every year. They can tend to use more and more as their economic circumstances improve over time. Mostly developing nations where the population growth is happening. So as I've mentioned before in previous videos, if you're in developing parts of the world and the population is growing, not only are there going to be more people using electricity, but there's going to be more people using more electricity. So each person, new person added to the pile, if you will, uses more electricity. That's where you get these convexity effects. So if the growth is roughly at 3% compounded for electricity consumption, that's not the same thing as growth for copper consumption to supply that electricity consumption growth. So that means there'll be a non-linear increase in copper demand due to the preference for green energy and to be able to move the power around onto the grid. Then you look at electric vehicles expected to add an additional 2 metric tons per annum to the demand side of the equation. So if we're looking in here, this gives us a great breakdown as to the jump in electricity consumption in 15 years from 2000 to 2015. And if you look at the breakdown of where that growth is coming from, I mean, you can see it's all the non-OECD, okay, Organized Economic Countries for Development, something like that. It's another shammy kind of organization. But the point is, it's all in the developing nations around the world where the population growth is going and where the consumption is growing. So you're going to get this double whammy effect. Okay, so if we narrow it down a little bit further, the growth is going to come from China, the USA, India, and Japan. So they're the big energy users at the moment. China's transitioning to natural gas and nuclear, which is smart. The US is says it's going to transition to renewables, which is a bad word. Let's not use renewables. It's solar and wind, okay? They're not necessarily renewables, which is a bad idea. Not by itself, but if you're relying on that alone, it's a bad idea. India, forget it, they're not interested. They are using coal at the moment. They would like to transition into cleaner sources of energy. They simply can't afford to, because they've got 1 billion people to feed. Japan potentially restarting nuclear fleet, okay, which is good news for nuclear. We'll talk about that another time. Regardless of the electrical fuel source, all of these companies need more energy sources, and all of them are going to increase electricity to some degree, and all that's going to require more copper, because all of that is going to require grid infrastructure upgrade, okay? So it doesn't matter what the fuel source is. If you want more electricity, you need more copper. Wind and solar. So if you look at the National Academy of Science for the US, there was a really, really good study done. I left a little link there, and I'm going to pick out the main bits, and we'll talk about that briefly. I really went in depth with this one, guys. So when you're talking about wind and solar, which is all the rage from certain factions, you got to understand something. They are so much more copper intensive that they're 11 to even 40 times as much in terms of copper intensive than your fossil fuel generated power. Then you've got to convert them mainly from DC to AC. Okay, that's why a couple of years back here in Australia there was all this thing about the solar panels catching fire, because they're direct current. Okay, they're often, so if you're looking at offshore wind, you got to get the power from where the turbine is on land to where the people are. So there's miles of infrastructure, wiring, tunnels, and all the rest of it. And you think about the amount of copper that's going to go into that. The grid itself needs massive upgrading because it's old and doesn't work very well in certain parts of the world. And if you think about all the substations and transformers, there's these huge copper coils, okay? More and more copper needed. Only 2 years of current global copper production would suffice to reach the 2015 goal. But this is very misleading, because that's an additional 2 years worth of supply, not only 2 years worth out of everything we produce. It's not the same thing. So if you look at it, and Horizon Kinetics cover this in great detail, I really suggest you download the Q4 report and read it. Even if you amortize that over 30 years, if you look at it on a CAGR, if you want to think of it that way, that equates to an additional 6.7% per annum additional load. So you'd have come up with 6.7% more every year. Okay, now it starts to come into perspective. But it gets worse. In the conclusion, the authors have stated that copper is the only material covered in our analysis for which supply may be a concern. So that's alarm bells ringing for me, because I know how cautious academics are in a lot of their statements. And if you look at what this covered, it didn't even cover the EV demand, okay? So it's very conspicuous that copper demand for EV, and of course if you have an electric vehicle you need a charging station, you need that all around, so it's its own infrastructure. It didn't even address that need, okay? We're really breaking it down here. I'll try and go through it as quick as I can. How many megawatts of rated wind power capacity are needed, and what is the associate copper requirement? And you can read this in the report. Okay, I've literally just cut and paste the most important parts here for brevity's sake. So if you say, let's say the power will be provided 50-50, offshore and onshore wind, okay? You need less wiring for onshore, obviously. Average copper requirements are £13,000 per megawatt of capacity. Wind turbines installed in 2020 had average power capacity, okay, of 5 megawatts. All right, 7-inch turbine. That might require 65,000 pounds of copper per turbine. But the 5 megawatt figure, this gets worse. The 5 megawatt figure is the max output. Okay, so that's, you're assuming that the wind is blowing 24 hours a day, and obviously that doesn't happen. Okay, usually the average capacity factor that engineers go off is 35%. Okay, so since wind is sometimes non-existent, too high, too low, the effective output of each windmill would be 1.75. Okay, which is 35% of 5 megawatts. An estimated household consumption is needed. Okay, so we need to say, well, is that big or does that matter? It depends on how much we're using, right? A common benchmark in the US is about 1,000 kilowatt hours per household per month. Okay, with that info, each turbine can support 1,278 homes. Okay, so one turbine could support 1,275 homes on that scenario. There are 123 million households in the US, so 96,200 wind turbines will be needed. Remember how many pounds of copper needed to create one wind turbine? At 65,000 pounds of copper for each of those 96,200 windmills, that would be 6.2 billion pounds of copper. That's about 13.7% of global copper production. That is more than a mountain of copper. If solar and wind power were only used for 40% of the supplies, you say, okay, well, we can't run it purely off solar and wind, that's fine. What if we can use it for just some? Fair enough. 40% household electricity supply, we're talking 5.5% of global copper production, and that does not include, again, electric vehicles and all the associated infrastructure needed for that. Okay, so this is why personally I'm bullish on the copper price. You may come to your own conclusions. These are just my opinions on the channel. Ways that I'm looking to play the thesis. So obviously you've got exposure to the raw commodity via the futures. So I'm looking at doing sort of rolling month on month, short the front month, go long the back month is an interesting way to play it. If you don't have access to the futures, JJC and CPER are two ETFs that track the futures, so you should be able to have any decent broker should get you access to the ETF. You might want to look at that. Producers, three big ones, Freeport-McMoRan, BHP, and Glencore. So we own Glencore in the fund and own it personally. I don't own the others. I have owned them in the past. I'd be interested in buying them at cheaper prices. The developers, two Aussie juniors down here. So there's Aries Resources and Hot Chili. Okay, Hot Chili, you can do your own reading on that. Interesting story. Will it happen? I have no idea. Aries is very interesting, and I'm going to cover that in just a moment. Some explorers. I don't know a lot about the explorers personally. I tend to steer clear from that neck of the woods, but you've got Oz Minerals, and the majors also have their own exploration projects in them. So I prefer to play that game by owning Glencore, because I get a cash flowing business, a global behemoth when it comes to commodities. They have fantastic assets, diversified, so it's not just copper, and they have everything from up and running mines, development projects, and exploration arms, and they've got a heap of cash that they can buy out potentially new developers or explorers if they strike copper or gold or any of the other commodities that the Glencore guys get after. So here are the ETFs I mentioned. Here you can see them. There's no difference between the two really in terms of lockstep. I believe that CPER futures collateralized by 3-month treasuries, okay, if that makes a difference for you. But you can see they track the futures movement in the copper price. Okay, so Aries Resources, I'm in Australia, so AIS.ASX, if you're not from Australia, that's how you get the right stock ticker. Quick overview, so they've got 2.2 billion shares outstanding, and market cap at time of recording was 304 million Aussie dollars. Enterprise value 236.5 million Aussie dollars. Share price has come down a bit, which is exciting, at 14 cents, and they've got negative net debt. So they've done some cash raising, they've got cash in the bank, they have some cash flow from operations. Go through and read the cash flow statement, it's quite interesting, and they're looking good. They're looking in a good position from my perspective. What I've done here, two future scenarios, one without dilution and one with dilution of 30% of shares on issue at time of recording. So if we're looking out this year, they're expected to be cash flow negative. If you're looking out into 2023, they're expected to produce 161.2 million in EBITDA. Okay, I've applied these growth rates that you'll see. Obviously, our discount rate is 20% because we want to get that as our minimum hurdle rate. And you'll look at the multiples. I am not counting on multiple expansion whatsoever. I am using very conservative multiples. So if the company is trading at only 1.5 times its EBITDA, and we're still making money, it tends to get my attention. I've got a bull case, a bear case, and a base case. I've weighted the base case at 50%, the bear case at 40%, so we're way overweight the bear case to be conservative, and the bull case only gets a 10% weighting. If you look at the EBITDA, the free cash flow, and the earnings per share on every metric, the company appears to be undervalued if you believe these projections. And so an intrinsic value is roughly 36 cents at the moment. And if you apply a margin of safety and say, can I buy it at 2/3 the intrinsic value, anywhere south of $24 for me personally would be $24.24 would be interesting. Do your own due diligence, of course. And if you look at the share count, I've changed the share count and said if they dilute further by 30% over the next decade, what does that look like? Okay, so it does have an impact, and it would bring the intrinsic value down a little bit, and the margin of safety would follow. And so to me, I'm interested in areas anywhere south of 19 cents. So disclosure, I do own the company, I own the shares. I'm looking to add to it in proportion in my personal portfolio. And it's an interesting company. So I hope you enjoyed that. My verdict today, long one, guys. Thanks for sticking around. I believe that supply is in deficit compared to demand, and so I'm bullish on copper over the next decade. A few different ways to play it. Thanks for watching. If you're interested in a value fund, you can look on eToro in the link that I'll leave in the description. And if you have funds available, you can invest if you choose, or you can just add it to a watch list and keep track of the portfolio. If you haven't already liked and subscribed, please do so. I really enjoy the comments. And as always, disclaimer, I'm not your financial advisor or anyone's financial advisor. I'm just a guy that likes to talk about investing, and I'm just giving my opinion on what I believe and what I'm doing with the money that I manage and my own personal money. None of this should be taken as advice or suggestions. You're responsible for your own due diligence and decision making. So having said that, I do hope that you enjoyed the video, and I hope to see you soon. Any questions, leave them in the comments, and I'll see you in another video.